Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA nrajca, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India. Worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice, had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executives. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar. Friends, in this session we'll be understanding what is CMA. In banking, CMA is called as Credit Monitoring Arrangement. This is nothing but an Excel sheet which will give information about the past of the customer in financial data, which is basically lifted from audited financial statements, and it will also give picture about future, that is what is they are having as estimate for immediate future, say that's next year, and what they have as a long-term plans for their term loan tenors, which are called as projections. So CMA is basically an Excel document which will tell to the bank about the financial performance of the customer in the past and what he is planning for the future. So the CMA will have 3 input sheets. The first sheet is called as operating statement, which is nothing but transferring all the data from the profit and loss statement of the customer. The second statement is called as liability statement, and the third statement is called asset statement, and details for all these will be lifted from the balance sheet. We'll see how a typical CMA will look like. This is how a typical CMA will look like. This sheet is called as operating statement here. So note here OPSMT. This sheet is called as operating statement. This sheet will capture information for the past years as well as for the future, all related to income and expenses of the business. So this sheet basically captures the information from profit and loss statement of the customer as far as the auditor is concerned, and as far as the future is concerned, it is dependent upon the data that is furnished by the customer. So it starts with gross sales, and it talks about various expenses from this point. Expenses like raw material, other spares, power and fuel, direct labor, other manufacturing expenses, depreciation, then stock movement, selling and general expenses, interest expenses, then operating, non-operating incomes. Then finally it talks about the profits and the tax component, and what is paid as dividend and what is a retained profit. We will understand all this concept one by one in the subsequent sessions, but this is how a typical CMA will look like, which is basically an Excel document. So this is the first input sheet. The second input sheet is the liability statement, where you will be giving all the information about the liabilities. The audited is picked up from audited financial statements. So here there is a mention audited. Audited is picked up from audited financial statements, and all these estimates and projections are something given by the customer, what he is planning for the future. So the liability statement will classify the liabilities into current liabilities, then all current liabilities will be listed, then term liabilities, that is those liabilities which are payable after 1 year, then it will break the other portion into net worth. This is nothing but the owner's contribution, which are in the form of capital, in the form of reserves, etc. So total liabilities will be captured in this statement, and next statement is asset statement, wherein all the assets which are available with the company and listed in audited balance sheet will be shown here under the audited column, and whatever they are planning for future, whatever the asset creation, that would come under estimates and projection. So the assets are divided into current assets, you have the total here, current assets, and current assets will have various classifications, then fixed assets, and there is something called other non-current assets, and the last element is intangible items or intangible assets. We'll be understanding each and every concept in the subsequent sessions. So I have shown you how a typical CMA will look like. So out of these various sheets, only these 3 sheets are input sheet. So if we feed data into these 3 sheets, there will be outputs in many other sheets that also let us focus. So by now you would have understood that in CMA, input have to be given from 2 statements. One is the operating statement and the other one is balance sheet. Balance sheet means basically the asset statement and liability statement. But if this input is given, then that CMA would give various outputs. What are the outputs? The first output would be a sheet called financial ratios. Financial ratios or financial indicators is the output sheet. So if all the data are entered in operating statement and balance sheet, this statement will be prepared automatically. This sheet will come automatically, which will talk about various financial indicators. So it starts with operating profit, then profit before tax, profitability, cash accrual, paid up capital, T&W, adjusted T&W, like that. It starts and goes on with many ratios, and the ratios goes to other ratios, efficiency ratios, then risk rating related ratios, and it keeps going on. So once you feed the data in those 3 sheets, you are going to get this sheet, and which is one of the important sheet in banking, because this is going to talk about all the wellness and bad things of the customer in terms of ratios. The second output what you would get would be the holding level sheet. This sheet basically talks about the levels of current assets and current liabilities maintained by the customers. So this is the holding level sheet. You will have it as WCC, that is working capital holding level sheet. Here this sheet would tell how many months of raw material stock has been maintained, how many days the funds are locked in stock in process, how many days of finished goods are maintained, similarly how many days of credit is given to the customer, then how many days of credit the customer enjoys from his supplier. All this detail will be available in this sheet. Then the next output would be the ABF statement. ABF is nothing but assessed bank finance. So this statement could tell the bank what could be the possible borrowing requirement for the customer for working capital. So this statement is called as the ABF statement. This statement would take the information from the balance sheet, and finally it would do some various calculation and would tell the bank what could be the assessed bank finance. So what is the eligible working capital finance for this particular customer. So this sheet is very important because it is going to tell how the company has financed its current assets, what are the combination, how much is from net working capital, how much is from bank finance, how much is from sundry creditors, how much is from other current liabilities. And it is also going to talk about certain critical number of days, which is very important in understanding the working capital management of the customer. So this sheet talks about all those, that is ABF assessment. The next output what you would get is fund flow statement. So what is fund flow statement? This statement basically extracts the data from balance sheet and P&L and will classify the funds used in the business and mobilized in the business into two types. One is long term and short term, and it would give very critical information to the banker how much of the funds have been mobilized from long term sources and used for long term purposes, short term sources and used for short term purposes, and crisscross how much of short term is used for long term and long term is used for short term. So this would be the statement FFL, that is fund flow statement. This statement would list out all the sources, all the source of funds, and when we say sources, all long-term sources, and it will also list all the uses. I mean, what are the long-term uses? Sources and uses will be shown separately. then at end of it, it would give what is the surplus or deficit out of all these sources. So there were some long-term sources, there were some uses. So after usage, there should be some surplus, or it can also be deficit. If there is surplus, how the surplus was used for further activities, or if there is deficit, how the deficit was managed. That's what I explained in the subsequent lines. All this we'll understand in a separate session. So in CMA we have to give input that is basically for past as well as for future. But when you give input for the past 3 years audited financials, you are facilitating, number one, to understand what is the trend of the company, how the company has moved in the past 3 years, and you can also get what could be the average performance of the company, and you will also get to know what is the latest year or immediate past performance of the company. Now let us list out the items in CMA one by one to gain some understanding. See, the first item is operating statement, so we list only the operating statement items. To start with, we have to give past 3 years information, number one. Number two, we have to give estimate and projection. So any CMA, it should have past 3 years, number one. Number two, it should give estimate for the current year and what you are going to plan for the projection, that's for the future year. So whatever the items we are going to discuss, that should be given for all these years. First is gross sales should be given, and from gross sales excise duty should be deducted and net sales should be shown separately. So this is basically the income. And on the expenses, to start with, the first expense should be raw material consumed, and that should be broken into indigenous and imported. This information is important because they have to understand how much is sourced locally, how much is sourced from outside country, because when it becomes an outside country purchase, obviously it would require something called letter of credit. For that purpose, this breakup is required. Number two, what are the stores and spares that have been consumed, and that should be broken into indigenous and imported. Then what is the expense incurred by the company on its laborers? So the direct labor cost should be shown here. Here the focus is on direct labor cost. We'll understand that in subsequent session. Then the power and fuel cost should be shown. After this, we have to show the other manufacturing expenses and depreciation. So with this, the total cost would be shown, and with this, opening stock in progress should be added and closing stock in progress should be deducted, and that would give the total cost of production. And with this, we have to add opening stock of finished goods and deduct closing stock of finished goods. That would give total cost of sales. And with this, selling and general admin expenses should be added, and this would give the overall operating cost for the company. And if this operating cost is deducted from net sales, it would give operating profit. And from this only we'll deduct interest cost, which should be broken into working capital cost and term loan cost. Then we have to add the non-operating incomes and deduct non-operating expenses so that we get profit before tax. From this, we have to deduct income tax, which is again broken into current tax and deferred tax. And deferred tax liability only the banks would consider. Then we get profit after tax, and from this profit after tax only the dividend will be paid. The first one will be preference dividend and the second one would be equity dividend. And if any profit is remaining after that, then that profit will be transferred to reserves and surplus. In the subsequent session, we will understand each and every item of the operating statement in detail.
Thank you so much. We have come to the end of this webinar, and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. I have published several courses on banking and financial analysis area, each course costing 2,000 rupees. But for you, I'm going to give you a special offer.
Here we go. Banking credit courses bundle. This includes
Course number 1, Banking Credit Analysis Process. It's a comprehensive course with 200 plus lectures. It covers financial analysis, working capital, term loan, LC, BG. It's a comprehensive ever course. Then we have course number 2, that is how to carry out financial analysis as a banker. This is going to focus exclusively on financial ratio analysis, cash flow analysis, and fund flow analysis. Then comes course number 3, how to carry out term loan appraisal and analysis as a banker. It's a comprehensive course focusing on the technical aspects around project finance and term loan. These are all the topics. Then comes course number 4, how to prepare CMA report for bank loan through 8 sections. This course will take you through entire CMA report preparation process for bank loans. Then we have course number 5, how to read balance sheet. So if you are a non-finance person, this course will give you complete insight into balance sheet, how to read them, how to interpret them, how to analyze them. Okay. Then we have course number 6, how to read CIBIL report. By taking this course, you will get a complete picture of CIBIL report reading process. Then we have course number 7, how to prepare cash budget for bank loans. This course will help you to understand the concept of cash budget, which is widely used in short-term lending like ad hoc credit facilities, letter of credit and all. So far I have introduced 7 courses of 1,999 each. It means 7 courses of value 13,993, but you are going to get it only for 2,599, and it is not yet over. I'm going to give you some more bonus. Course number 8, Collateral Securities, a comprehensive study. Course 9, how to carry out credit risk rating for non-trading entities. Course number 10, in this course you will learn banking credit analysis through various case studies. So now it is 10 courses of value close to 20,000, but you are going to pay only 2,599. It is not yet over, some more bonus. Course number 11, how to read audit report. Course 12, this focuses on letter of credit, and course 13 focuses on financial analysis in very short duration. So you have 13 courses of value close to 26,000 rupees, but you are going to get it for just 2,599. So it is basically 7 main courses, and you are going to get another 6 complimentary courses, 6 courses as bonus. So overall it is 13 courses of value close to 26,000 rupees. It's 1,500 plus lectures. You get lifetime access for all these pre-recorded courses. You can access them in desktop, laptop, mobile, iPhone, iPad, and the overall cost is around 26,000, but you are going to get it only for 2,599. So this is a once in a time opportunity for you. Enroll now. I'll see you inside the course.